Hello everyone, welcome to the first English episode of Smart Money Flow. My name is JQ, and today I'm going to talk about the relationship between S&P 500 and the expected real interest rate, aka the TIPS. Before I begin today's content, I would like to do a brief introduction about this channel and a little bit about me. So, as you can see, this channel is about everything in the financial markets, but mainly I would only focus on the American stock market and the futures market and the options. But I'll also talk about the crypto market and as well as the bond market, because the bond market is very important, especially for the macro condition, and usually there are some very profitable opportunities that could show up in the bond market. And for me, I am a Chinese Canadian trader. I can speak both Chinese and English. And previously, if you looked at my videos on this channel, you could see that I did most of the market analysis in Chinese only. But recently I felt that there's a need to make some English content on this channel to boost my viewership and to increase the number of subscribers. So that's why I'm doing this market recap or the market analysis in English today. And I think in the foreseeable future, I'll continue to make weekly market analysis every weekend in English. But for the daily market recap, I will continue to do it in Chinese, unless my viewership or my subscriber count increases in the future. I will be more motivated to do more market recap in English on the daily basis. Otherwise, I won't have the motivation to do it because it's a lot of work. I hope you guys understand. But I still hope if you are an English speaker and you find my channel and you love my content, please hit the like button and give me a subscribe. So without further ado, let me begin today's topic. So what is TIPS, you may wonder? TIPS is actually an abbreviation for Treasury Inflation Protected Securities. If you study economics in your college days, you should know this Fisher equation, which states that the real interest rate is equal to nominal interest rate minus inflation. And as you may know, the financial markets are forward-looking, meaning that we look at what will happen in the future. So if we want to know what the expectation of the real interest rate is in the future, we look at these 10-year TIPS. Here is the CNBC app site showing the 10-year TIPS. You may wonder how we can calculate it. Actually, the 10-year TIPS is calculated as the difference between the US 10-year Treasury bond yield and the 10-year break-even inflation rate. You could do it in on the TradingView website easily by typing US 10Y minus T10YIE, and then you could get this variable, and here I showed it already. It's right now trading at 0.723%. Very close to the official number here. So that's the TIPS. So what's the relationship between a real interest rate and the stock price, you may wonder. Here I'm going to talk a little bit about the economic theory underlying the real interest rate and the output. So in economics, we divide the factors of production into 4 categories. First is land, the second is capital, and the third is labor, and the last one is entrepreneurship. And in particular, the real interest rate is the cost or the price of of capital. So higher cost of capital usually will reduce the firm's profit. The firm's profit, aka the EPS, will go down. And if the EPS go down, the stock prices goes down. So that's the logic behind it. So for example, here I give a very simple profit function. If you study economics at school, they usually give you this type of profit function to solve, right? In your micro theory course, I presume. That's what I did when I was an undergrad. Anyways, so here's the profit function, and you can see R goes up, the cost is higher, you have less profit. Less profit means lower EPS. So that's the underlying economic theory. Okay, so that's only the theory, but let's look at the some empirical background, or in the real world. So in the real world, you can see that there's a pretty negative correlation between S&P 500 and the real interest rate, aka the TIPS, or the expected real interest rate. I should emphasize the word expected. This is the expected real interest rate, because in the market we are always forward looking. We always look into the future. The stock price will react to what may happen in the future. So if the real interest rate, or the expected real interest rate is going to go up, that means the firm's profit will likely go down. Then the stock price will react and go down as a result. So that's why you can see this negative correlation since 2022, and we can basically eyeball it and see this very obvious negative correlation, right? So a more interesting question you're gonna ask is, could we quantify this? Could we look at this in a more quantitative way and see how much S&P 500 will go down if real interest rate goes up by 1%? And to do that, I try to run a very simple linear regression, and I assume most of you know what linear regression is. You learn it in your first year statistics course or your first year econometrics course. If you don't know what it is, it's just a statistical method to correlate two variables, to extrapolate a linear relationship between two variables. So that's what regression is. Anyways, I run the regression, and here's the scatter plot, and you can see there's a very negatively correlated relationship between these two variables, and the coefficient is negative 41.75. What that means is that if TIPS goes up by 1%, the SPY will go down 41 points on average, holding other things constant. That translates to 20% downside minimum. But of course, there's a caveat. The caveat is that this is very simple analysis, and SPY is not a stationary time series. So my my analysis may be too simple, but I think within this particular market regime, I think my estimates shouldn't be too far off, because in this market regime, they have a very strongly negative correlation in this market regime. So even with this simple OLS linear regression, I think the relationship will hold in the near future. I'm not going to say it will hold forever, because in the short term or in a more longer term, the relationship may break. But in a very long term, or in the theory, there should exist a negative correlation between these two variables. So that's part one I want to talk about. So just from the real interest rates point of view, you could see that there's more downside in the overall market. Okay, that's part one. The second part I want to talk about is Apple. Why? Because I think Apple is quite expensive with its current PE ratio. So first, we have to notice that Apple has the highest market cap weighting within S&P 500. Secondly, if you check Yahoo Finance, you will find that Apple has a beta of 1.23. What does that mean? Well, that means if S&P 500 falls 1%, Apple should fall roughly 1.23% on average. That's just in theory, or in a very long-term perspective. That should happen. So let's just look at the historical PE ratio of Apple. So here I use Python to make this historical PE ratio for Apple. So if you look at this chart, the green line is the 95% confidence interval upper bound, and the red line is the 95% confidence interval lower bound, and the orange line is the long-term average since 2009. So you could see the long-term average is around 17 times PE. But right now, Apple's PE is roughly 25, with its EPS year-over-year growth rate at only 18%. But its PE is roughly 17%, so it's quite expensive, even if you take into account the growth rate. So that means at least 25% to 30% downside on Apple. Especially in this tightening period, the Fed is not printing money. The Fed is tightening. The Fed is sucking out the liquidity out of the economy. So in this kind of environment, Apple is very expensive. So if Apple falls 30%, the S&P 500 should fall about 25% if we use this beta to calculate an estimate of its downside. So that's part two. So that's what I want to show you guys about this analysis, basically. So here's my conclusion. My conclusion is that first, the S&P 500 should make a new low if the Fed remains hawkish. And the second conclusion is the real interest rate, the higher it goes, the worse it is for the American stocks. And I think the S&P 500 will fall to at least 3,500. But will it go lower? Will it go lower than, say, 3,300? That I'm not sure about, but I think that's very likely, because in my analysis, I only take into account Apple and the real interest rate. But in a more real-world setting, there's other variables we need to take into account. For example, the quantitative tightening Fed is doing right now, and also the contagious effect from the emerging markets. Those are the macro factors we also need to take into account. But in today's episode, I'm not going to talk about those, and that's my long-term view for S&P 500, which is that I think it should go new low in the future. But let's just look at its chart and do some basic technical analysis. So if you look at this S&P 500 E-mini futures daily chart, you could pretty easy to see that there's a support around 3,900 here. So that's a very key support level. So in the short term, we have to rely on the technical analysis to tell us what's going to happen. So if it breaks the support in the near future, in the short term, that's very bearish. That will trigger more downside. If we can hold this support, it may bounce back a little bit more. But in the long run, I'm very bearish. So that's the key takeaway from my video. Okay, thank you very much for watching my latest episode. And if you like my channel and like my content, please give me a like and hit the subscribe button. I'll see you guys next weekend. Thank you. Bye.